Hello everyone, in this video we will continue to dig into the gameplay of CASHFLOW 101 and discuss some details, primarily around assets and liabilities, which are the most important pieces in this game. So what are assets and liabilities in this game? Long story short, assets are defined as investments that can potentially generate passive income for you, which means after investing, you just wait and you can gain profit in the future. The profit may come in two ways. One is cash flow, for example, your net gains from rental properties or stock dividends. And the other is appreciation when you sell the assets. Note that an asset may not guarantee a positive gain in either one. For example, some rental properties may have a negative cash flow and you are mainly investing in its future value appreciation. And all investments carry risks, so you may sometimes end up at a loss when you sell that property. Assets are generally opportunities, not guarantees for passive income. And you have to do your own assessment to determine if any specific investment is a good idea. Then how about liabilities? Liabilities are simply the debt you are carrying, which generally also requires a monthly payment to pay it back and cover the interest. It is a constant expense on you until you pay it off. Examples include your primary home mortgage, school loans, car loans, and credit card debts. And you know what? If you bought an asset with a mortgage, for example, a 3-bed, 2-bath rental property, it is your asset, but the mortgage part also becomes your liability. We will cover that later on. Now let's dive into the details of each concept. Asset. In this game, there are these types of assets: cash, stocks, housing, land, gold, personal loans, and businesses. There are businesses in both rat race and fast track, but the ones in fast track are a lot bigger. Other asset types like stock, housing are only available in the rat race. Cash saving is an asset, but it does not have a potential to generate passive income unless you turn it into things like some certificate of deposit. Stocks. Just like the normal stocks you see in the real-life market, stocks have a price that keeps changing and you can purchase any amount of shares as you feel comfortable. No options or margins in 101, but the 202 edition would add that. To buy stocks, you have to get a stocks deals card, which lists the symbol of the stock, the current stock price, the dividends, who can take this opportunity, and also its past moving range. There are two ways to make money with stocks. One is through dividends, which becomes part of your cash flow, and the other is simply buy low and sell high. So if you see a stock is low in price, usually reflected by comparing to the price range, you likely can get some gain later on. At the same time, when you get a stock deals card, everyone including you can choose to sell shares they own at that listed price. Of course, after you sell it, you lose the corresponding dividend in your passive income. There's one note about the stocks though, that is stock split and reverse split. A stock split means the stock will be divided into smaller shares. For example, if you own 50 shares of the stock at $20 each, when it splits 2-for-1, the share price will simply be cut in half to $10, and at the same time, your share count doubles to 100. So eventually nothing happened to your net worth because you still have a total value of $1,000, and the dividends are also adjusted accordingly to remain the same. A reverse split is simply the opposite, where the stock unit price goes up and your total share counts go down. But what does that mean for the game? Keep in mind that the cards in this game are fixed in print. Let's say you bought a stock at $15 and its moving range is 10 to 30. 15 seems a pretty good buying price in this case, but if you hit a stock reverse split of 1-for-3, your share price would jump to 45, while your market cards will still only give you selling opportunities mostly at 10 to 30 range. This means you will most likely get an investment loss. This is actually a good design to ensure that you still see the risks of buying stocks at a seemingly low price, because in real life, there's no guarantee your stock price will go back to its previous high. To buy stocks, calculate the total buy unit price times shares. Give the bank that amount of cash, add the entry to your balance sheet, and add the total dividends of your passive income. To sell stocks, remove the amount of shares from your balance sheet, get money back at that selling price, and remove the corresponding dividends from your passive income. If there is a stock split, lower the stock unit price and increase the stock shares by the given ratio. Your total dividends should not change because the dividends per share also goes down like the unit price. Do the opposite for the stock reverse split. Housing. Housing basically means things like condos, houses, apartment buildings, etc. You buy it and then rent it out. Usually it is bought with a mortgage, and you use your rental income to pay for the expenses including monthly mortgage payment, interest, and property tax. Therefore, when you get a deals card about housing, you can see its down payment requirement, its real cost, and its cash flow. The down payment is the money you have to pay right now, and the difference between down payment and the cost is the mortgage amount you owe the bank, and that will become part of your liabilities. There is also an ROI number, return of investment, which is simply about how much down payment you can get back with 1 year's cash flow. Some of you may already have noticed another thing. That is why in this game we typically have a home mortgage to start with, but it is not listed as an asset. The main reason is in this item, cash flow. The cash flow of housing is a simplified number in this game, which is simply the net gain between the rental income and all the related expenses. But do you have cash flow with your primary residence? No, because you do not earn any income from it. You are living in it. So if you still carry a mortgage for your primary residence, it's only your liability, not your asset. Even though you can sell it after its appreciation to get a gain, as you still need a place to live, whatever you gain will be spent on the next primary residence you buy. And when your house has appreciated in its value, unfortunately, the one you are buying next is also more expensive now. There may also be an unfortunate event with housing, that is foreclosure. If there is a market downturn like during the 2008 crisis, foreclosures are not rare. By definition, mortgages are secured loans. With a secured loan, the borrower promises collateral to the lender in the event that they stop making payments. And when that happens, the bank as a lender would take the house away from you to hopefully make up for the debt that you still owe them. And you will no longer be responsible for that debt. That is a foreclosure. So if there is a foreclosure on your balance sheet, you would remove that asset, remove its cash flow, remove the liability, get no extra money back, and that's all. To buy housing, pay the bank cash of the down pay amount, add the housing to your asset list, add the cash flow to your passive income, and add its mortgage to your liability list. To sell housing, get cash at the selling price and then pay the bank back for the mortgage amount, and then remove the housing from your asset list along with the mortgage and the cash flow. In terms of foreclosure, the selling price is equal to the mortgage amount, so you essentially get zero cash back. Land. Land is also a type of real estate, so it works similarly to housing. However, land is not a residence. Therefore, land investment usually requires less money, but it also has low cash flow. Usually you invest in land to hope for value appreciation. Buying and selling land is similar to housing. Gold. Gold is pretty similar to stock in some sense. Its price constantly goes up and down, and the quantity is generally measured by weight. There's no split or reverse split in gold, but in real life, its price is never guaranteed either. Gold has no dividend, so it has no cash flow. The only way to make money from gold investment is to sell it at a higher price. Personal loans. Personal loans are pretty straightforward. You simply lend some money to another person, and the person promises to pay you back within some time period with extra interest. But there's no guarantee that the person would actually pay you back, and you have to actually actively track the schedule and collect the payment. So you have to assess the risk. Businesses definitely work differently from houses, but game-wise it is handled very similarly to housing. You pay the down payment and get the cash flow. In this game's fast track, however, there's no investment loss anymore because the risk is mainly taught during the rat race, and the fast track is typically designed for you to enjoy the way you scale up your investment. A few special notes about businesses in the fast track. First, most businesses can be invested by multiple players. When you invest in a business, you should place a token of yours on that business, and if you are the first one who invested in this business, everyone else following you must pay you an additional $50,000 mentoring fee to invest in the same business. Second, there are some business investments that require rolling a die, and you can only successfully purchase it if you succeed with the rolling. For such businesses, once someone successfully purchased it, it is no longer available to others. So these are the assets covered in this game. To play this game, you usually only have to pay attention to the numbers listed on the cards. But each card actually also has some pretty good scenarios described as deal context, which I highly encourage you to read, because those are also learning opportunities. For example, in this selling opportunity, the buyer is making an offer due to his 1031 exchange running out of time. By looking up 1031 online, you can learn that it is a way to defer taxes. If you sell a house at a profit and then buy another similar house through 1031 exchange, you may defer your taxes on the profit if you meet specific rules. But you must buy the second house within a specific time window. So if your buyer is on a 1031 exchange, that puts you into some extra advantage in real life in terms of negotiation power. Or if you have a house in mind that you will buy next, you can also consider 1031 exchange to defer your own tax on this sale. So don't just skip the texts. Read them. Liabilities. Liabilities are simply debts that you owe the banks. It can be a home mortgage loan, credit card debt, student loan, car loan, personal bank loan, and your mortgage taken to fund your investment. They require you to pay back periodically, usually with interest. So they become part of your regular expenses and are often a reason that you cannot get out of the rat race. Some loans have a very high interest rate, for example credit card debt, and some have a low interest rate, like school loans. Therefore, no matter whether in the game or in real life, you should try to pay off the ones carrying a high interest rate early. In this example, paying off $4,000 of credit card debt will lower your monthly payment by $140, but paying off a school loan of $12,000 can only lower your monthly payment by $60. You can easily see the difference. On the other hand, the game does not let you pay off mortgages of investment properties. That may be for the simplicity of the game design, but in reality, certain types of debts are also considered good debt compared to others, because instead of taking money out of your pocket like credit card debts do, they put money into your pocket. It also allows you to convert your credit into investment power so that you can scale up your investment portfolio even faster. For example, let's say you have $100,000. You can use that to buy one house with all cash at $100,000 with no liability, or buy 5 houses of the same price with 20% down payment each. That results in $400,000 liability in total. But what happens if you sell the houses when their prices grow by 20% each after 3 years? If you bought one with all cash, you will get a simple $20,000 profit. But if you sell the 5 houses you bought with mortgages, guess what? your total profit is $100,000. That growth rate is much higher than the interest rate the banks charge you, so your gain is a lot more. Of course, as we noted before, investment may not always grow in value, so when you take these debts, you are also taking a much higher risk. For example, if you ended up selling the houses at $80,000 each, with the all-cash case, you lose $20,000, but with the mortgage case, you lose the entire $100,000. It also could trigger a foreclosure, and that's what we don't want to see. Therefore, when using leverages, you must assess your investment choices very, very carefully. Things like taxes or child expenses are not liabilities. You cannot pay them off, and those expenses are mandatory. So now we have covered the details of assets and liabilities in this game. The real-life experience is definitely a lot more complicated than a board game, so the game is mainly to help you get started by teaching you the basics. For real-life investments, you have to go beyond the game to learn more and practice more. We are also making a video to discuss the similarities and differences between the cash flow board game and real life. Stay tuned!